strategies to ride out market volatility as we head into a new year. How to pick a credit card that's right for your finances. Plus, we visit a retirement home where everyone is under the age of 40. If you had $1,000 to invest, what should you do with it as we head towards the end of 2024?
Fundamentally, there are two ways that any investor can diversify, especially the young ones. One is you diversify in time, which means how many pieces you break that $1,000 into. Second is how much you spread it across various instruments. You don't want to do it so much that it becomes cumbersome, and you don't want to do it all in one go, because then you will have the feeling of regret in case the market corrects. So a typical rule of thumb approach would be to break it into 2 or 3 tranches. And when it comes to instruments, if you're taking a long-term view, then picking something very simple like a S&P 500 ETF works well. Maybe you can add one more ETF for US Treasuries if you want to keep a balanced thing.
If I had $1,000, I would probably look to invest in something that's globally diversified, a mutual fund or a unit trust that is invested in global equities across various geographies and maybe across various sectors as well. I would also look to buy into an exchange-traded fund, which again is globally diversified. Because I think diversification is something that's very important. And I think one should not underestimate the importance of diversification.
That's especially because of the multitude of uncertainties in the global economy as we head towards the final stretch of 2024. The big event for investors is the US election.
In the case of Trump, if he wins elections, that's going to throw up economic and political uncertainty. Trump has talked about imposing hefty tariffs on US imports. He's talked about immigration curbs. On the positive side, he's talked about cutting taxes, which are good for equity markets. And if he wins, then the markets are going to be worried about what he'll do next, and we'll have to wait, pause, and watch for a while before we get a better bearing of where things are headed. With a Harris victory, there's greater chance of political continuity, greater chance of inflation weakening further into 2025, and a greater chance of the Fed continuing to cut interest rates perhaps once a quarter in 2025. And that's good news for investors. Less uncertainty, more good news for investors.
One strategy for investors is to ignore the political noise and focus on the medium term.
What investors should be doing is looking out to invest over the next 12, 18, 24 months. That sort of time frame. Now, if you take that sort of time frame, then I think we have greater confidence that the markets will be able to deliver decent returns over the next 2 years or so. But it requires an investor to be patient. It requires an investor who can stomach volatility in the markets, because the markets are going to be volatile with so many moving parts happening right now. Quality is important at this juncture, especially if you have a sharp economic slowdown or even a recession. You want to be holding things with good quality, good credit matrices, and good fundamentals generally.
Others say a buy and hold strategy would work instead of trying to time the market.
It's just buying and holding good quality stocks is generating the growth in the portfolio. As a long-term investor, it's very important to prevent or to avoid the temptation of trying to time, because the last 2 years have shown that trying to time the market has not really helped. Of course, we saw some corrections along the way in April, then we saw another small correction in August. So we did see some blips, but generally not trying to time the market has played out well, versus there are many investors who probably sat on cash thinking, let's wait for that big 15% correction, which never actually came.
Analysts expect equities to continue their blockbuster streak. And while US stocks have dominated investor portfolios, value can be found in places like China and here in Singapore.
We think Singapore market is still very undervalued. It's not gotten much attention from global investors, but I think Singapore companies offer pretty good yield, pretty good corporate governance, and because it's undervalued, I think as money rotate from markets that are a bit more overvalued in search of better value elsewhere.
Bonds and REITs have also become more appealing as inflation eases and interest rates start to fall.
3 months ago, we were neutral on bonds. Now our overall weighting in bonds has gone into modestly overweight, because we think that as interest rates are cut, the search for yield will continue. In fact, it will pick up pace, and that is going to result in more money going into bond markets in search of that yield. And we think that emerging market bonds, Asian bonds are actually well placed to benefit from the flow of money, especially emerging market and Asian bonds in the high yield space. But having said that, I think it's important for investors, if they're investing in high yield bonds, to look at the fundamentals of the companies they're investing in. There's chance, of course, a default in the high yield space.
I think as the rate cut increases, it'll reduce the pressure on the REITs balance sheet, because for the last 2 years they have really been under pressure with low rental yields and high interest rate. So the minute that pressure is reduced, the valuations will start coming back, and we'll see more increase in the value of these REITs as the interest rate goes down.
According to OCBC, gold continues to be a good play. The precious metal has already rallied by close to 30% year to date, and it could hit a 12-month price target of $2,900 an ounce. One potential risk heading into the new year is a correction in the AI rally, even though the sector is seen as having long-term potential.
In terms of valuation, there's a healthy correction that happens, which is not bad. But the healthy correction actually triggers, thanks to the algorithmic trading that happens today, it triggers a massive sell-off, both on the back of algorithmic trading and your Reddit forums, where everybody starts saying, let's dump, sell, sell, sell. There's panic. And then it spills over into the broad-based market, which can create more margin calls, more panic selling. And we may suddenly go from a 5-10% correction of the large tech in spilling over into a broad-based market.
Despite the risks of volatility, corporate earnings out of the US are proving resilient. And data from past rate cuts could also give investors another reason for optimism.
If you look at history, you find that each time the Fed cuts interest rates, and if we have a soft landing and no recession, typically equity markets tend to react positively 12 months on from the first Fed rate cut. So we had the first Fed rate cut in September, and if there's no recession over the next 12 months, then Fed rate cuts typically tend to produce a positive outcome for equity markets.